Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, listener, and thank you for joining me today. Wow, what a week. I must admit I have mixed emotions at times like this. Professionally, we can become very focused on helping you, our clients, stay invested when the performance of your holdings is taking a hit. And I really believe that it's in times like this that how you react is really key to long-term investment returns. So, staying invested is a critical message we try to deliver to our clients. Personally, however, I always get very interested, maybe even excited, and maybe it's the wrong word, but when I see a sea of red, and I'm obviously looking to increase my own investments as markets go on sale. So today I have with me Abhilash Narayan, a senior investment strategist within the CIO office, to discuss the implications of this exciting and inverted commas week for investors. So good morning, Abhilash. How are you feeling? It was a pretty long week, I guess.
Good morning, Steve. Yeah, absolutely. It has been a long week, so feeling a bit exhausted, but to your point, feeling a bit excited as well to see whether we have some interesting opportunities to invest.
Okay, so obviously we've seen massive volatility over the course of the past week. I mean, obviously oil, we'll talk about in a moment, has been the epitome of that, but other asset classes fluctuating quite significantly as well. Maybe I can get your perspective on how you think about investing during such volatile markets.
Well, you rightly pointed out it has been a volatile week, and sometimes we don't acknowledge that it's not only challenging to invest from an intellectual perspective, but also from an emotional perspective in times like these. I mean, just this week we saw European equities rise by over 7% and oil decline by 10% in just one day, and all of that was just based on comments from Ukrainian officials that they were willing to talk to Russia. And this just goes to show the extent of bad news or downside that has been priced in the market. But more importantly, it's also a great reminder that investors face significant cost of missing out, or what we call the COMO factor. Now, a lot of us may not realize, but for long-term investors, the cost of not being invested in the best days of the market is huge. So for instance, if an investor missed out on just five best daily returns in S&P 500 since 1988, so that's almost 34 years, the cumulative return would be lower by almost 37%. And if investors miss the best 30 days, their cumulative returns over the last 34 years would be lower by almost 80%. Now, we all know that timing the market is extremely difficult, even for professional money managers. So to your point, Steve, remaining invested and dollar cost averaging has time and again proven to be a good strategy to navigate such environments. And if investors have additional cash on sidelines, they may also want to consider accelerating their purchases in the current drawdown, since that as well has historically delivered superior returns as compared to simple time-based dollar cost averaging strategy.
Yeah, I think you make a great point in terms of trying to separate emotions from the sort of more rational side of the brain, but it isn't easy, right? So I think we have to acknowledge that one of the key risks facing us at the moment is the oil market. So it's really been an amazing 2 years for oil prices, going from being paid to take delivery of oil in April of 2020 to touching almost very briefly, actually, but over $140 this week. Higher oil prices increases inflationary pressures. It also, is implicitly a tax for businesses and consumers, so it can weaken growth. So, how concerned are you about this threat to the global recovery?
Well, there are no two ways about it. Higher oil prices, like you mentioned, are clearly a drag on global growth, especially from a consumption angle. Now, over the past week, we've seen some OPEC plus producers such as UAE indicate their willingness to increase production, but we have seen decline in oil and gas exports from Russia. And when we combine that with low inventory levels, it could mean that oil prices can stay above $100 per barrel for the next few months. Now, overall, global growth is likely to be dented, but it's important to remember that we are starting from a strong point. So at start of the year, for a number of major economies such as US and Europe, the expectations were that they would deliver above trend economic growth. So we do have some buffer to play with. But that being said, the risk of stagflation has clearly increased. And that is something that policymakers and investors will have to keep an eye out for.
Okay, so let's move on to policy reactions. That's obviously a very critical component of any analysis that we do. So we've had some major announcements from Europe this week. So we're looking at the Fed next week as well, of course, which we'll talk about in a moment. But what do you make of Europe today?
Well, if you look at the numerous developments from coming from Europe this week, two really stand out to me. The first one is that we're starting to see contours of concerted policy action forming in Europe, which could help the region counter growing stagflation risks. So, for one, EU officials will be meeting to discuss how to support regions' economies most impacted by the conflict in Ukraine, and any agreement to share the debt burden of EU members with an aim to subsidize the region's companies and consumers from rising oil and gas prices, as well as boosting defense spending, could be a major step forward for EU fiscal policy. And this, more aggressive fiscal policy could also help counterbalance the more hawkish ECB reaction we saw overnight, where they chose to accelerate the winding down of bond purchase program. And this was primarily driven by inflationary concerns. So, just last night, ECB unveiled its new forecast that raised the inflation outlook this year from 5.1% to 5.1% from 3.2% earlier.
Okay, so obviously we've got the Fed meeting next week as well. That's going to be the primary focus, I guess, for markets. They've taken a pretty hawkish stance of late. Do you expect that to continue?
Well, by and large, yes, because if you think about it, the Fed faces a similar challenge from elevated inflation as what Europe does. And if you look at the latest February CPI data, which came out last night, it shows that CPI rose at 7.9% year on year, which is the highest in 4 decades. And it's important to remember that the February data was captured before the latest spike in oil prices. So for March data, obviously, higher oil prices are probably going to put an upward pressure on inflation. Now, if we look at long-term inflation expectations in US, they have broken higher as well. And all of this just increases the pressure on Fed to hike rates to fight inflation, even as the continued flattening of the US Treasury yield curve suggests that investors are becoming increasingly concerned about the medium-term growth. So, all in all, while markets are, looking for a near certainty of a rate hike in the upcoming meeting on 16th March, we will also keep a lookout for, Fed's medium-term growth and inflation projections to see whether policymakers are, starting to become concerned about stagflation risks.
Okay, so I guess when we're looking at global equities, the summary is that look, the markets are pricing quite a lot of bad news already. Policy drivers not necessarily turning totally supportive yet. There are some positive signs there, but we're not necessarily out of the woods. But this still seems to be an opportunity for investors to be averaging into sort of diversified allocations. Let's move closer to home and look at Asia. So while we're talking about tightening in the US and Europe, markets, we're looking for policy easing in this part of the world, particularly China, of course. Markets don't seem to be convinced that this is for real. My sense is people are maybe a little bit too focused on the global risks, but China has been easing for some time. And this, following announcements this week, looks likely to continue. So what do you expect here, and what are the implications for Chinese equities?
Thanks, Steve. No, Chinese equities are approaching a very key technical support level right now. So MSCI China is almost 5% above the key support level of 67. And this is important because MSCI China has fallen by about 45% since its peak in 2021. Now, this drop is already larger in magnitude when we compare it versus other significant pullbacks, such as the 32% drop in 2018 amid trade war fears and the 43% decline in 2015 post the crackdown on A-share margin financing. Now, over the next 12 months or so, we think that Chinese equities are sort of overdue for a technical rebound, and we continue to view them as a preferred market within Asia Japan, which in turn is a preferred region globally. Now, we see increasing evidence that China is likely to ease both fiscal and monetary policy further to achieve its ambitious 5.5% GDP growth target. And Chinese policies are in stark contrast to US, where obviously monetary policy is beginning to tighten. In addition to that, if you look at China's credit impulse, that has again bottomed out. So that's again positive sign for the overall economic growth, but also for earnings growth. So we think that a lot of bad news as far as regulatory tightening is priced in, and Chinese equities have a high likelihood of outperforming global equities in the next 12 months.
Yeah, I think another factor that I think is important is obviously that the labour market's been loosening there. So we've been seeing job losses coming through in China, and obviously that's particularly this year, but in any year, that's a significant factor, I think, in the decision-making stance of the authorities. So we do expect further easing to come through. Does this change the outlook for China high yield bonds? They've been pretty beaten up of late. If I look at my portfolio, that's one of the areas worst hit. So what's the outlook there?
Absolutely. I mean, Chinese high yield property sector has been battered by this, a string of concerns. And if I look at their performance, they stand nearly 60% lower than the levels seen in May 2021, making this an unprecedented sell-off. Now, authorities have taken a number of steps to ease the strain on property sector, including easing sector restrictions in over 50 cities, reducing down payment requirements, and even relaxing mortgage rates. But clearly, these measures have fallen short of restoring market confidence. Now, the sharp decline that we have been seeing in property sales year to date, just adds to the cash flow challenges for property sector developers, especially since the asset disposals have proceeded at a slower pace than anticipated. We also have a significant wall of maturities coming through in March and April, so the next few months could be volatile. But if we take a longer sort of outlook, we think that the ambitious growth target set by Chinese authorities should lead to further support for the sector in terms of loosening of policies, especially for the developers. So, while the sentiment remains fragile and bond prices remain low, we think that the risk reward remains skewed to the upside over the next 6 to 12 months, even if we see a bit of volatility in the near term.
Okay, thanks, Abhilash. It's been really great talking to you as always. And thank you, listener, for joining us today. I hope that it's been useful when it comes to navigating through these challenging markets. I think the key message today is to stay invested in a diversified portfolio and look to add to holdings on weakness, as we believe this will stand you in good stead over the longer term. How you respond in the coming days and weeks, we believe, will be critical to your long-term investment returns. As always, if you like what you've heard, please feel free to like, review, and subscribe to the Money Insights podcast channel, available on Google, Apple, and Spotify podcast channels. You can also find a lot of our content on our LinkedIn Wealth Insights page, including some of our publications, blogs, opinion editorials, and videos. With that, I'll sign off. Please take care and stay safe. Until next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.